In 1997, a company went public with almost no profits, negative cash flow, and a promise that sounded irresponsible. It would prioritize growth over earnings for as long as it saw opportunity. Most investors heard risk. A few heard leverage. 25 years later, that same company would surpass $1 trillion in market value. This is not a story about selling books. It is a story about cash flow timing, capital discipline, and the psychological endurance required to build a machine that compounds faster than doubt. This is how Amazon became $1 trillion system. In 1994, the commercial internet was barely formed. Bandwidth was scarce. Trust was fragile. Credit card payments online felt risky. Yet one former hedge fund executive at D.E. Shaw saw something others ignored. Internet usage was growing at 2,300% per year. His name was Jeff Bezos. He did not begin with a vision of global dominance. He began with a spreadsheet. 20 product categories. Books, 1. Not because he loved literature, but because books had millions of SKUs, standardized inventory, and no single dominant retailer online. The insight was financial, not romantic. Unlimited shelf space plus centralized inventory equals negative working capital potential. From day one, Amazon was designed as a cash flow machine disguised as a bookstore.
At Amazon, we put the customer at the center of everything we do. This relentless focus drives us to innovate and deliver.
Our purpose is to be Earth's most customer-centric company.
Most investors thought this was branding. It wasn't. It was a capital allocation blueprint.
Our strategy is to put the customer first. This approach has driven our innovation.
Putting the customer first meant lower prices. Lower prices meant thinner margins. Thin margins meant Wall Street skepticism. Amazon went public in 1997. Revenue grew aggressively. Profits did not. The company reported losses year after year. Analysts asked a simple question: when will this business make money? Bezos reframed the question: how fast can we grow free cash flow if we reinvest everything? He prioritized revenue growth, customer acquisition, and infrastructure over quarterly optics. During the dot-com crash, many internet companies collapsed. Amazon survived because it had raised capital early. Timing mattered. Capital structure mattered. Investor psychology mattered more. The lesson? Raise when markets are generous. Preserve cash when markets are fearful. Amazon cut costs ruthlessly during 2000 to 2001, but it did not abandon long-term bets. Survival was the first victory. But reinvestment built infrastructure. Infrastructure built speed. Speed built trust. Trust built habit. Customer obsession wasn't philosophy. It was leverage. In 2000, Amazon allowed third-party sellers onto its platform. This decision changed everything. Instead of owning all inventory, Amazon could collect fees. Instead of capital tied in goods, it could monetize traffic. Margins improved. Risk shifted outward. Working capital dynamics strengthened. The marketplace model created a flywheel. More sellers meant more selection. More selection meant more customers. More customers meant more sellers. Investors began to understand. Amazon was not a retailer. It was infrastructure for commerce. Asset-light layers built on asset-heavy foundations. Capital efficiency quietly improved, while reported profits remained thin. The market initially underestimated this structural shift.
Good evening. Amazon has just announced a major expansion into new markets. This move is expected to create thousands of jobs worldwide.
In 2005, Amazon launched Prime, free 2-day shipping for an annual fee. Critics called it expensive. Shipping costs were rising. Logistics infrastructure required billions. But Prime was not about shipping margins. It was about psychological commitment. Once customers paid up front, they shifted behavior. Order frequency increased. Average lifetime value expanded. Predictable subscription revenue reduced volatility. Prime transformed Amazon from transactional retailer to embedded utility. The lesson for investors: recurring revenue stabilizes valuation multiples. Markets reward predictability more than sporadic profitability. In 2006, Amazon launched Amazon Web Services. At the time, it looked unrelated to retail. Internally, Amazon had built massive server infrastructure to support scale. The realization was simple. Excess computing capacity could be rented. Startups no longer needed to buy servers. They could lease computing power. AWS carried significantly higher margins than retail. For years, it funded Amazon's expansion. Public investors initially struggled to value it properly because it was hidden inside consolidated reporting. When AWS margins became visible, valuation multiples expanded. Amazon was no longer judged purely as a retailer. It was compared to software companies. The capital markets re-rated the stock.
Amazon reports record quarterly profits driven by cloud services and a surge in online sales.
Expansion required physical dominance. Warehouses multiplied globally. Delivery fleets expanded. Aircraft were leased. Robotics integrated. Billions reinvested. Critics warned about thin margins, but infrastructure created control. Control reduced dependency. Over time, scale lowered per unit cost. Amazon converted fixed costs into strategic barriers. Competitors faced a dilemma: match infrastructure and bleed capital, or concede speed and convenience. Investors learned a critical principle: heavy upfront capital expenditure can produce durable monopolistic advantages if utilization scales. Amazon did not just dominate the US market. Early international expansions into Germany, the UK, and later India were carefully chosen for high population, low e-commerce penetration, and scalable logistics. Each new market meant adapting to payment habits, consumer trust, and local supply chains. Investors often underestimated the hidden capital costs and slow adoption, but the payoff was structural. Global brand recognition, diversified revenue streams, and an ability to hedge regional downturns. The lesson? Global optionality compounds enterprise value, even if early cash flow is negative. Amazon made selective acquisitions to bolster logistics, technology, and customer stickiness. Whole Foods added instant physical footprint. Zappos brought customer-centric culture. Robotics investments improved fulfillment speed. Ring and Home Tech expanded ecosystem reach. These acquisitions were rarely about immediate profits. They were capital deployment plays, monetizing attention, accelerating delivery capabilities, and embedding Amazon deeper into daily life. Investors learned the subtle art of optionality. Not every investment generates immediate cash, but some shift the trajectory of competitive advantage.
Thank you for joining us today. I am pleased to announce a remarkable 44% growth in customer orders.
Scale carries weight. Regulatory scrutiny intensified across the United States and Europe. Labor relations became contentious. Thin retail margins meant operational mistakes could compress earnings quickly. During aggressive expansion phases, free cash flow occasionally dipped negative. The COVID-19 surge amplified revenue, but also ballooned fulfillment expenses. When demand normalized, excess capacity pressured margins. The stock experienced volatility. The lesson? Dominance increases scrutiny. Infrastructure amplifies both upside and downside. Investors who misunderstood cyclical normalization mistook temporary margin compression for structural decline. Throughout its history, Amazon avoided dividends. It rarely repurchased shares in early decades. Capital was recycled into growth. Data centers, content streaming, international expansion, artificial intelligence. This discipline required investor alignment. Shareholders who demanded immediate profits exited early. Those who understood compounding stayed. Over 20-plus years, revenue compounded at extraordinary rates. Operating leverage slowly emerged. Free cash flow eventually strengthened. Market capitalization crossed $1 trillion. Patience converted volatility into generational wealth. Amazon tested emotional endurance. The stock fell more than 90% during the dot-com crash. It experienced multiple 30 to 50% drawdowns over 2 decades. Yet the thesis remained anchored in scale economics and reinvestment logic. The investors who won were not those who predicted quarterly earnings perfectly. They were those who understood the architecture of the business. They focused on customer growth, Prime adoption, AWS margins, and long-term operating leverage. Markets fluctuate. Business models compound.
We are at the forefront of innovation, and our future has never been brighter. The opportunities ahead are immense, and we are ready to seize them.
Amazon never rested on its laurels. Physical stores, cashierless checkout, drone delivery trials, AI-driven supply chains, and recommendation engines exemplify continuous reinvention. Each cycle required upfront investment, patience, and investor alignment. Financially, innovation cycles act as capital accelerators. Successful experiments scale revenue, enhance margins, and create barriers. Investors learned. Optionality creates asymmetrical upside if the company can fund continuous experimentation without jeopardizing core operations. But to truly understand why Amazon became unstoppable, we have to go deeper, into the mechanics most investors missed. By the time Amazon reached global scale, most people thought they understood it. A retailer, a logistics empire, a cloud company. But the real engine was cash timing. Customers paid up front. Suppliers were paid later. That gap created float, temporary liquidity that expanded as revenue grew. While earnings showed losses, operating cash flow strengthened. Growth began to fund itself. Investors focused on profit saw weakness. Those focused on cash flow saw leverage. Then the flywheel took hold. Lower prices attracted customers. More customers attracted sellers. More sellers increased selection. Scale reduced costs. Financially, this reduced inventory risk, lowered capital requirements, and improved efficiency. The system reinforced itself. AWS transformed the valuation story. Retail margins are thin. Cloud margins are high. With recurring revenue and strong margins, AWS improved the quality and predictability of cash flow. Markets rewarded that stability with higher multiples. High-margin cloud profits helped fund retail expansion. Ecosystem layers like Prime Video and devices deepened retention. Higher retention increased lifetime value and reduced churn. Amazon stopped competing per transaction and started embedding itself into daily life. By the time most investors understood the full machine, the gap was already wide. And at scale, growth brings pressure. Dominance brings scrutiny. During COVID, Amazon expanded rapidly, adding warehouses, workers, and logistics capacity as e-commerce demand surged. Revenue soared, and the company looked unstoppable. But hypergrowth can distort reality. When demand normalized, excess infrastructure pressured margins, and the stock corrected. The lesson? Not all growth is durable. Scale must be absorbed, not just achieved. As Amazon's power expanded, regulatory pressure followed. Antitrust concerns, labor scrutiny, and data control debates introduced political risk into its valuation. Once a company becomes infrastructure, financial performance alone no longer defines its worth. Leadership transition added another test. When Jeff Bezos stepped down and Andy Jassy took over, markets questioned continuity. But Amazon had institutionalized its systems. Discipline, capital allocation, and long-term thinking were embedded beyond the founder. Meanwhile, Heavy investment in automation, AI, and cloud deepened operating leverage. Short-term profits were pressured, but long-term efficiency improved. Amazon's journey reveals core capital market truths. Cash flow funds growth better than earnings optics. Infrastructure compounds advantage. Recurring revenue stabilizes valuation. Optionality creates upside. And endurance outperforms emotion. Amazon did not become a trillion-dollar company because it avoided risk. It structured risk. It layered systems. It recycled capital. It tolerated volatility. It reinvested relentlessly. The valuation was never the objective. It was the byproduct. A byproduct of architecture, patience, and engineered inevitability. And in capital markets, inevitability is the rarest asset of all.
We are thrilled to announce that Amazon has reached a market cap of $1.5 trillion, a new milestone.
Today, Amazon represents more than e-commerce. It represents a blueprint. 1. Capture attention. 2. Monetize through infrastructure. 3. Reinvest aggressively. 4. Build optionality layers. Marketplace, cloud, subscription. 5. Accept short-term criticism for long-term positioning. In an era of artificial intelligence, automation, and platform consolidation, the lessons remain relevant. Infrastructure businesses command durable multiples. Recurring revenue stabilizes valuations. Negative working capital can fund growth. Capital raised in optimism should fortify. Amazon did not become a trillion-dollar company because it sold more products. It became a trillion-dollar machine because it mastered capital flow timing, reinvestment discipline, and psychological endurance. Profits were delayed. Infrastructure was prioritized. Optionality was layered. Investors who understood the difference between earnings and enterprise value captured one of the most powerful compounding stories of the modern era. The deeper lesson is quiet but profound. Markets reward those who can endure discomfort longer than competitors. Amazon endured. Capital followed. If this changed how you see money, subscribe. These documentaries are built for thinkers, not spectators. And if you're serious about mastering capital, watch the next video on your screen.